Hello, and thank you for joining our financial market call for the first quarter of 2025. My name's Ben Rathvon, and I'm part of the financial advisor team at HB Retirement. Our call today will be led by our investment strategists, Joe Kelly and John Kirkpatrick. They'll provide an overview of the state of the economy, possible changes that we could see with the new administration coming into office, and a review of investment performance of 2024 and where we may see the market move in 2025. At HB Retirement, our goal is to participate and protect. We'd like to participate as much as possible in the market upside while also attempting to avoid downside. This chart is a powerful example of why protecting from downside is so important. The red bars show a potential loss, and the blue bars show a gain that's necessary to get back to even after that loss. So if we dig ourselves a deep hole, it can be very difficult to work our way back out of it. And these market gains and losses are something that we're experiencing in real life. This chart tracks the performance of the S&P 500 back to 1981. The blue lines show where the S&P finished each year, but the red dots show the drawdown that it was experienced each year. The average intra-year drawdown over this timeline is over 13%, which is why protecting from the downside is just as important as trying to participate in the upside of the market. As I said earlier, our call is going to be led by our investment strategists, John Kirkpatrick and Joe Kelly. And with that, I'll pass it over to John. Thank you.
Thank you, Ben. So let's jump right into the presentation. So since he was sworn in as president on January 20th, Donald Trump has already signed an extensive number of executive actions, and we know he is eager to make some significant policy changes while in office. So let's take a look at some of those major policy changes that have been talked about and how they could have an impact to economic growth. So we're going to start with the policies whose impact would likely encourage economic growth and be positive for investments. So first, deregulation. Just a few days ago, I saw a well-known investor and billionaire named Stanley Druckenmiller on the news, and he was quoted saying that, quote, "We are going from the most anti-business administration to the opposite. CEOs are somewhere between relieved and giddy." So that really speaks to the excitement that some businesses have for the potential change in the regulatory environment. Obviously, the less regulation increases likelihood of a business's willingness to invest. So some of these reduction in regulatory policies could be implemented quicker without congressional approval, but the reversal of some of the major regulations and, as we've heard, talked about the elimination of entire government agencies would obviously take more time and need some approval from Congress. Now, also as a positive for growth potential, tax cuts. So the Tax Cuts and Jobs Act from Trump's first term is due to expire at the end of 2025. There's a focus on extending and expanding these cuts, which would likely be a positive for the economy, really to prevent the drag that could occur should there be any expiration of those cuts. The administration would also like to reduce the corporate tax rate from 21% to 15%. That would make the U.S. one of the lowest tax jurisdictions of any wealthy country, a large wealthy country. This could prove more difficult given the already large federal deficit that exists and some pressures to increase spending in areas like defense. These would obviously require congressional approval, and the earliest that these would be implemented would, of course, be in 2026. So now, on the other hand, let's talk about some of the major policies that could create challenges to economic growth if they are implemented. One being tariffs. There's a lot of headlines in the news about how tariffs will be implemented, how they will be deployed. Trump has come out in the past saying that he would like a 60% or more tariff on Chinese goods, and then a 10% baseline tariff that's applied universally on goods from other countries. It remains to be seen if this is part of a negotiating tactic or a threat, or if we will see these be enforced, and for how long really is the question. How long will these exist? Tariffs likely would be inflationary on the short term, as prices would be increasing. But over the long term, they also have the potential to dampen aggregate demand. There is a concern that businesses would be less likely to invest when there's some uncertainty, and especially that could happen if we start to see retaliatory tariffs from other countries. And then lastly, the restrictive immigration. There's two components of this. We start with the securing and closing of the southern border. We'll eventually see impact on that to industries that rely heavily on migrant workers, especially agriculture. This could be implemented very quickly, but a much larger proposal is the plan to deport all of the undocumented. That's estimated around 15 to 20 million. This is a very sizable effort, would be a very sizable effort, requiring a lot of resources, be very expensive. So it remains to be seen how they would plan to go about doing that. And obviously that would take much longer to enforce and to accomplish. So let's move on to some economic data points. First, let's talk about inflation and labor dynamics. So on the left-hand side, we have a chart of the CPI, and after seeing 4 consecutive months where CPI came in slightly hotter than expected, we finally had a downside surprise in the month of December, and that brought the core CPI number down to 3.2%. Markets have been a little bit more hawkish, which has caused yields to move higher, given that the expectation for rate cuts has diminished. But really, the story on inflation is still a cooling trend. Data is going to be choppy moving forward, especially as we get more information on how policy changes like tariffs will be applied and how inflationary that could be. But we still see that cooling trend in place. On the right-hand side, we see the wage growth data on the upper right. We are getting back to pre-pandemic levels. You can see there's still a cooling trend in wages, and we're at a very healthy rate of 4.2%, which really is a pretty decent area to be in, where we're above the rate of inflation, but still in a acceptable growth rate for the Federal Reserve and their perspective. So we still see this continue to cool, but it's not collapsing, and it's gradually coming back to more normal levels. And on the bottom right, we see the new jobs number, monthly jobs report, and we're seeing gradual normalization here as well. This is more of a slow cooling versus a collapse, as we continue to see robust growth in the economy. So I wanted to go through some additional labor market data and really show that overall the labor market remains in good shape. Unemployment has been steady at just above 4% for the past couple of months, so we've seen that flatten out. But on the right-hand side, that's a really interesting chart that shows that the increase in the unemployment rate that we saw from 2022 through 2023, that was mostly the result of a decrease in hiring, which is the red line, versus a result of layoffs, which is the blue line. So layoffs are obviously more harmful to growth. So that's really positive that any increase that we've seen in the unemployment rate really isn't a result of an increase in layoffs. So now I'm going to pass it over to my colleague Joe Kelly to talk about Federal Reserve expectations as well as some market performance data.
Thank you, Ben and John. Hi, everyone. My name is Joseph Kelly. I'm an investment strategist on our team. I'm going to be talking about returns for different investments in 2024. But before diving into that, I wanted to talk about the Federal Reserve. Now, the Federal Reserve sets a key interest rate known as the Fed funds rate. And that interest rate influences other interest rates, such as credit card rates and savings rates. The current target range has a low range of 4.25% up to a high range of 4.5% for that interest rate. Now, the charts on this slide show the implied probabilities from investors for potential changes in the Federal Reserve's next two meetings. As you can see, both the January meeting, January 29th, and the March meeting have the majority of the implied expectations at no change to the interest rate. Now, investors and the Federal Reserve do expect that interest rate to be lowered in 2025, but more modestly than previously expected. Now, what does that mean for investors? For investors that are invested in ultra-safe money market funds, they can expect a potential yield based on those expectations of about 4% averaged out through 2025. And however, for more risky investments such as stocks, there could be some pressure placed on those investments as borrowing costs for consumers and companies remains elevated throughout 2025. All right, let's look at investment returns, and this table can be broken out into a few different areas. On the far left column, you can see different investment areas categorized as either equity or stock indices, fixed income or bond indices, and then alternative indices, which are made up of broad commodities, which include things like agriculture, livestock, and oil, as well as real estate in that alternative section there. Now, the returns I pulled are for the calendar year 2024, but also returns that go through January 20th, 2025 on a year-to-date basis, a one-year basis, and a 5-year annualized return basis as well. But let's just talk about 2024. Now, the S&P 500 is an index that's made up of the 500 largest publicly traded US companies, and it returned roughly 25% in 2024, which is fantastic. And that was largely driven by growth type companies. And growth companies can be thought of as typically younger companies with faster growing revenues and profits. They performed at 33.4%, which is really great, outperforming value companies, which can be thought of as typically more mature companies that have larger dividend payments to their shareholders, returning 14.4%, which is great, but underperforming on a relative basis. Now, small companies in the US also relatively underperformed. And outside of the US, you can see international developed companies performed really weak at 3.8%. That was due to difficulty for those economies, some weakness in those economies, as well as a really strong US dollar compared to other currencies. Now, emerging markets did better at 7.5%, and those are countries such as India and China, with companies in those countries. And then on the bond side, you can see US high yield did fantastic at 8.2%, and investment grade did more modestly at 1.3% in 2024. Now let's look at broad commodities. Broad commodities, the prices on aggregate increased by roughly 5.4% in 2024. And what's interesting is through January 20th, those prices have increased by roughly the same amount so far on a year-to-date basis. And real estate also lagged at 4.9% in 2024. Now let's dive in and talk about the S&P 500 a little bit more on a specific basis. All right, on this slide, I have the S&P 500's calendar year returns since 1957 through 2024, bucketed into different return buckets. As you can see, the majority are in that 5 to 15% return bucket, but a not insignificant amount also fall into negative return buckets as well. Now for 2024, the price return was 23.3%, which outperformed roughly 75% of other calendar years. So a really great year, really outperforming the median calendar year return of 11.9%. And on the back of a previously great year in 2023 of 24.2%. You can see here falling into this bucket, that 15 to 25% bucket. So underperforming a couple of other return buckets for different calendar years, but still a very strong year. Now, the S&P 500 set 57 all-time highs last year. It also had a really modest max drawdown of 8.5% throughout the year. So it did a great return year with not a significant amount of risk. Now, John's going to look at how combining both the great year of 2023 and 2024 compares to other 2-year trailing calendar year return periods, and we'll show just how difficult it is to achieve what we have in 2023 and 2024 compared to other calendar years.
Thanks, Joe. So like Joe said, we had an extremely strong 24-month period for U.S. equities. We had back-to-back gains of over 20% in 2023 and 2024. So that's a pretty rare event in and of itself. The last time we saw that happen with back-to-back 20% gains was in the late 1990s. But when you also look at just the overall 2-year 24-month returns, the past 24 months ranks in the top 4 going back to 1957. So as you can see from this chart, we only had 3 other instances of a 24-month period that had higher returns in the S&P 500. So Joe mentioned that there were 57 all-time highs reached in 2024. That means on average a new high was reached every 4 trading days, which is a pretty impressive feat. Similar to 2023, last year we also had a very concentrated year for outperformance. So this chart is looking at all the individual companies that make up the S&P 500, plotting them on a chart and using relative returns versus the index. So any bar below the x-axis here at 0 would mean that it underperformed. Anything above would mean that it outperformed. And so what we see is that there were only 28% of companies that actually outperformed the return of the index. And most of that came from the mega cap top 10 names in the index. And those are the companies that we have highlighted here. So we have every company in the top 10 with the exception of Microsoft actually outperformed the overall returns of the index. 69% of companies had positive returns, 31% had negative. Now, moving into 2025, we do expect to see some broadening out of performance. We are seeing the earnings gap between the mega cap, those Magnificent Seven companies, and the rest of the market continuing to narrow, which should benefit just overall breadth of the market. So while it may feel like you left gains on the table by owning the entire index versus just owning some of the mega cap, Magnificent Seven, more growth technology names that significantly outperformed over the past 2 years, when you actually expand the time window, the results tend to look much different. So what this chart is showing you, performance of the S&P 500 versus performance of a portfolio of the largest 25 companies in the index at that particular time. So we have 3 different dates that we're looking at. We go back to 2004, so a 20-year look back. We go back to 2014, so a 10-year look back. And then we also go back to 2019 for a 5-year look back. And in each instance, when you look at the S&P 500, which is the navy blue line, in each instance, that index actually outperformed that portfolio of the top 25 companies. So there's a famous quote from Mark Twain in which he says, "History doesn't repeat itself, but it often rhymes." And that's something, we talk about a lot in the investment world. We've seen other time frames like what the time we're seeing right now, where mega caps have continued to outperform. That doesn't last forever. And so what we're showing here is the largest periods of outperformance when you take the top 10 of the S&P 500 versus the overall index. And you can see those in the blue shaded side of the slide. What we do want to show you though, and what's the takeaway here, is to look at what happens following that outperformance. So what we see is that in both positive and negative market environments, the following 12 months, the S&P 500, so the overall index, has outperformed the top 10. So we see that broadening out. We saw it happen in 97 and 98. We saw it happen again in 2000 and 2001 on the, outperforming on the downside, and then again in 2022 when markets were negative again as well. Now, currently we are 6 months into our, that fourth sort of time frame here. So we are still seeing the index underperform slightly versus the top 10. So there's still 6 months left to go before we hit that full 12-month period. And based on some of the narrowing earnings gap that we've seen from the mega caps and the rest of the market, as well as sort of the interest rate environment, we do think that there still is time for that index in the broadening out of performance, improved market breadth. We still think that there's opportunity for the index to outperform and become less concentrated than it has been.
All right, the last slide that I wanted to leave you with prior to talking about the potential outlook for stocks and bonds moving forward is this regional return comparison. You can see the United States versus other geographies such as Europe, Japan, Canada, and Australia across different return periods. So 1989 to 2001, 2002 to 2009, and then 2010 to 2024, that post global financial crisis period. Now, the United States has outperformed by significant amounts in different return periods. You can see 1989 to 2001 really outperforming, but these periods of significant outperformance typically, and at least historically, have not lasted forever. You can see in 2002 to 2009, the US only performing and returning 13% over a cumulative return period across those 7 years, really outperformed by all other markets, led by Australia at 226% over that 2002 to 2009 period. So comparing that 1989 to 2001 period to the current significant outperformance that we're seeing today from US stocks, it's important to consider that return regimes can change and international can outperform again potentially. So diversification is definitely an important part of a well thought out investment plan. So something to keep in mind looking forward. Now, one thing that our team researched and that gives us a bit of pause is that the percent of consumers expecting stocks to increase over the next 12 months hit an all-time high over a most recent reading. And as you can see, a really interesting report by the Conference Board. And typically, over exuberance or significant confidence in stocks can lead to some increased volatility once weakness shows up. So one thing that gives us pause and that we're continuing to monitor. Now, I listed some potential headwinds and drivers for stocks looking forward. On the driver's side, artificial intelligence, the innovation there and the energy needed and necessary for those processes. Artificial intelligence really is an energy intensive area, so some build out needed there. And this has really been a driver over the past couple of years and could potentially be a driver looking forward as well. I put strong household balance sheets. So the unemployment rate in the US has remained historically low at 4.1%. So individuals have had wage gains that have been strong. They've had asset prices of things that they own, such as real estate and stocks, growing quite significantly, putting them in a strong balance sheet position to continue purchasing and consuming. So something that could definitely be a driver looking forward. Corporate profits. So profit increases in the U.S. are expected to be over 10% on a year-over-year basis in 2025 and 2026. And then also strong competitive advantages. U.S. companies at least really have strong advantages and are able to drive really quite wide profit margins. So something that has helped and can continue to help, I expect, looking forward. Now on the headwind side, we have market concentration. So those companies such as NVIDIA, Microsoft, Apple, Amazon, Google, and so on really have such significant allocations and weights overall in the US that if one of them has some weakness, some potential investment doesn't pan out for a specific company, could weigh on returns looking forward. Equity valuations are definitely lofty, definitely pricey currently, at least compared to historical values, and then lower dividend yields. So returns for investors can be made up of stock price increases or dividend payments received, and the dividend payments received are definitely lower compared to historical values. Now, the final thing I put is higher bond yields. So on the asset allocation decision, if bonds look attractive and longer maturity bonds continue to increase in terms of the yield that investors can expect to receive, that could weigh on stocks as investors potentially put more of an allocation towards bonds. Now, all of these points I think are definitely important, but what's really important is investors talking with their financial advisors, discussing their goals, objectives, and risk tolerances when they decide the decision with regards to their asset allocation. Now, the last thing that I wanted to leave you off with regards to the outlook for stocks, we found some really great research on bull markets. And a bull market starts after a bear market, so stocks are ticking down and dropping in prices, and then they bottom, and then they start taking off. And right here, you can see the bear market bottom. That would be this left column here. And then on the right, you can see where it peaks again would be the bull market peak. Now, bull markets typically last about 5.1 years, and that's this period here of rising stock prices. Right now, we had a bear market bottom in October of 2022. So we're only about 2.25 years into this bull market, so relatively young from a duration perspective. Now I listed out years, the return years after the bear market bottom. So the first year, second year, and third year. And as you can see, returns are really strong in the first year and second year. And as you can see with this most recent bull market at 21% and 32%, falling in line with historical averages. The final column here is the year 3 of the bull markets. 4 bull markets that lasted that long had an average about 5.2% return, still pretty healthy and strong, but a little bit weaker than the previous 2 years. And something that we could potentially see, especially given that this year 2 of our bull market was 32%. I don't expect returns as strong as that, but we could definitely see positive returns given the potential growth in corporate profits in 2025 and 2026. Now I'm going to pass it off to John to talk about the outlook for bonds.
So finally, let's take a look at the current shape of the yield curve. So the red line is the current yield curve. We also have on there the historical percentiles of where that yield ranks. What we're seeing, is a pretty flat yield curve, slightly upward sloping. So it's no longer inverted, and we do have pretty healthy yield across maturities. So whether you're in the short end or the long end, obviously not getting paid a lot of a premium for the long end, which is why the short end does continue to be attractive. And it's very attractive for savers and investors, but also a headwind for borrowers as rates continue to be somewhat restrictive. So when you look at the 10-year yield at 4.6, that's actually 100 basis points or 1% above where it was when the Federal Reserve started their cutting cycle in September of last year. That, we actually saw the front end of the curve drop by 100 basis points as well as the Fed has implemented their rate cuts. We're expecting to see some further steepening with the short end of the curve potentially coming down slightly. There currently is one additional rate cut priced in for 2025. That would bring the front end down to between 4% and 4.25%. But expectations for inflation and growth are they both continue to trend towards target, but at a fairly slow pace. So I wouldn't expect to see a lot of rate cuts here in the near future. So that likely means higher rates will be here for longer, well into 2025.